All right, welcome back, everyone, to a New Views Wednesday workshop at 1. If you tuned in last week, we gave you a little recap of what to expect for our new real estate series. Our guest speaker today is Matt Bowles. If you haven't heard him before, he has presented in the past in early 2022, but he is back and he has some great information with you. Before we do get started, New View is not a financial, give any tax, legal, or investment advice, but we are a self-custodian. So we give you the ability to invest into alternative assets using your IRAs, your ESAs, which are education savings accounts, ESAs, which are health savings accounts, and your solo 401ks. And you can invest in all kinds of assets like real estate, doing private lending, mortgage notes, tax liens, a variety of alternative investments that are outside of the stock market. Now, if you are tuning in and you have any questions, there are two different ways that you can submit your questions at the end of the presentation. You can, if you register through the landing page, then you want to follow the directions on the left to submit your questions. And if you are watching live via social, just type those in the chat, and then we will read those at the end of the presentation. All right. So don't forget to submit questions for the panel at the very end when we bring back all of our guest speakers. And you can scan this QR code to start submitting those. And that will be asked, like I said, at the end, the very final episode when we bring back all the guest speakers. All right. So introduce our guest speaker, Matt Bowles. So he's the co-founder of Maverick Investor Group. He's been the founder since 2007, is a fully remote real estate brokerage to help you buy turnkey real estate in the United States markets from pretty much anywhere. And Matt and his co-founders at Maverick have helped individual real estate investors buy over 100 million in residential investment properties across the United States. So with that, I'm going to go ahead and bring on Matt. Matt, you are good to go. Go ahead and share your screen and we'll get started.
All right. Welcome, everybody. So glad to be here. Thank you so much for having me. I'm just going to try to share my screen here a little bit. Can everybody see the screen that I'm pulling up here? Looks good. All right. So first of all, just want to thank everybody for jumping on today and joining us for this webinar. Let me do a little more of an extended introduction on me so you'll have a little bit of context on who I am, and then I'll talk about what we're going to cover today in this educational webinar, and then we will jump into it. So I am one of the co-founders of Maverick Investor Group. You may have seen us in some of the real estate investing press over the years. We've been featured in a lot of different places. We've won different awards in the real estate industry, but we have done one thing and one thing only for the last 15 years, which is helping you, individual real estate investors, buy cash flowing rental properties in the most investor advantaged U.S. real estate markets, regardless of where you happen to live. So that is our need, and we have focused specifically on that. The way that we've developed our business model and the way that it works is that we help you to buy, first of all, in the most investor advantaged markets, okay, which change over time. And we help you to do that regardless of where you personally have to live or need to live. Number two, we help you to buy turnkey rental properties, which are either brand new or fully renovated properties with tenants and local property management already in place at closing so that you don't have to be the rehabber or the landlord. Number three, we help you to access off-market rental properties that are not available to the general public. And finally, we have the deals come to you so that you don't have to spend your time looking for them. You can just evaluate the deal and conduct your due diligence. You don't actually have to find the deals, right? So we provide you access to private buying opportunities. So that's the business model. That's what we do. And that's how we work with our clients, okay? So with that context, what I've put together for you today for this educational webinar is, first of all, understanding why the advantages of single-family rental properties are turbocharged in 2023. Number two, how to identify investor advantaged real estate markets. Number three, what are the 4 reasons to buy your rental properties turnkey? We're going to talk about what that means and what the advantages are. Then we're going to talk about how to conduct your due diligence if you're buying an out-of-state rental property that's not near where you live. I'm also going to share with you the market where I just bought a rental property with my New View self-directed retirement plan over this past year. I'm going to show you where that was. I'm going to show you all the numbers. And And if you want to buy one near me, you're welcome to do that. I'll show you exactly where it is. And then finally, I'm going to talk about the number one mistake that real estate investors are making right now. And then we're going to take your live Q&A at the end of this webinar, but feel free to drop comments in the chat as we go along if you would like to. So to begin with, we need to talk about the advantages of single family rental property investing as an asset class, okay? Usually when you buy an investment, there is usually one potential profit center. You're buying stocks, something like that. You hope and pray it goes up in value. If it does, great, you can make some money. If it doesn't, you don't make money, right? It's usually that simple. Sometimes there's a second stream of income if you have a dividend paying stock, or you're buying cryptocurrency and you stake your crypto and you earn some yield on it or something like that. Once in a while, there's a second stream of income, potential profit centers. But when you buy and hold rental properties, you actually have 5 profit centers that can work for you at the same time, right? So you have your positive cash flow. If you buy right, your tenant's rent should cover all of your expenses, plus an estimate for maintenance and vacancy, and then have positive cash flow on top of that coming into your bank account every month. Then you have the potential for market appreciation. The housing market can go up in value. You can build equity that way. But even if it doesn't go up in value, profit center number 3, your tenant's rent covers your mortgage payment, which means your tenant is paying down your mortgage principal for you. So you're building equity that way, even if the market does not go up in value. Then you have the tax benefits. When you buy and hold, not flip, but hold rental properties, this is very different from a primary residence now, okay? But if you buy and hold a rental property, the government incentivizes you to do that by providing you incredible tax benefits, right? If you're willing to provide housing to your fellow citizens so the government doesn't have to do it, they will heavily incentivize you through tax benefits, okay? They allow you to depreciate the value of your property, even if it's going up in value, and you can take that as a paper loss against your income from the property. They also allow you to do what's called a 1031 exchange, where you can indefinitely defer your capital gains tax and your depreciation recapture if you comply with the process and reinvest your proceeds from the sale into like-kind properties, okay? Obviously not tax advice. Consult your CPA on how to do all of this properly, but they are there for you in the tax code, and the government does offer those benefits, which can be very lucrative to real estate investors. And finally, there is a built-in hedge against inflation, and not just a hedge, but you can actually profit from inflation by holding your rental properties, okay? How does that work? Well, first of all, home prices rise with inflation. Second of all, rents rise with inflation. And third of all, if you borrow a 30-year fixed rate mortgage, you are borrowing that money in today's real dollars, but you are paying it back in future diminished nominal dollars that are worth less than the ones you borrowed, okay? So instead of inflation debasing your wealth, which is what it does if you keep your money in a bank account, it just destroys your buying power. Rather, if you invest it in a long-term hold rental property, inflation debases your debt that you owe to the bank, and you actually profit from inflation, okay? So those are the 5 profit centers of buying and holding residential investment property. In addition to that, real estate is the most debt-favored asset class. So you can get a mortgage and use the bank's money to acquire your property, okay? And you get 100% of the appreciation, even though you may have only put down a small percentage of the purchase price. That is how financial leverage works. And you are able to borrow that money in today's real dollars, as I just mentioned, and pay the bank back in future diminished nominal dollars, okay? So now that we have gone through that baseline understanding of the advantages of the asset class in general, let's look at 2023. What are the current trends today going into this year that are turbocharging these advantages of owning single-family rental properties? First of all, the official rate of inflation is still over 7%. The official rate of inflation by comparison in the last decade, from 2010 up to 2020, averaged about 2% per year, okay? The official rate of inflation going into 2023 was 7.1% per year, okay? And remember, the higher the inflation, the higher the profit for the owners of the rental property, because you're now benefiting from that inflation and profiting from it, okay? Now, let's look at today's mortgage rates. One of the things a lot of people have been noticing is that mortgage rates have been going up over the last few years significantly. Okay. Well, a couple of important things to keep in mind, right? Obviously, they're doing that to try to ease inflation, right? A couple of things to keep in mind, though. First of all, mortgage rates are still historically low. Certainly, they're higher than they were 3 years ago, but historically speaking, they are still historically low, even at the rate that they are today. All right. The second thing is that rising mortgage rates correspond with increased rental demand. Remember, if somebody is trying to buy an entry-level home and the mortgage rates have gone up significantly, that makes their mortgage payment more expensive. So they might not be able to afford that entry-level home now because the mortgage will be more expensive for them. Therefore, they are pushed into the rental market. Therefore, there's more rental demand, and that pushes upward pressure on rents, okay, which benefits the rental property owner. Also, rising mortgage rates have historically corresponded with rising home prices. All 6 times that interest rates have been raised since 1994, in every one of those examples, home prices have also risen with the rising interest rates. Now, why would that happen? Well, remember, if somebody buys a house and they lock in a mortgage at 3%, and now in order to buy a new house and get another mortgage, their mortgage is going to be over 6%, that is going to be significantly more expensive for them to maintain a house, even if the house costs the exact same amount. So they are going to be incentivized not to sell their house, to keep their mortgage. They understand that the mortgage note with that super low rate locked in for 30 years, that is the asset. And they're going to hold on to that mortgage note by any means that they can, and they are not going to sell that house. That helps to keep properties off the market. That helps to lower supply, and lowering supply generally helps to drive those home prices up, right? There's more demand than there is supply. That drives home prices up. So those are some of the dynamics that are going on in today's market. And then the other thing that's really, really, really important to understand is that even though mortgage rates are higher today than they were a few years ago, the real inflation adjusted mortgage rates are actually lower today than they were a few years ago. Okay. And so what you need to do to understand inflation and to understand real mortgage rates is to subtract the rate of inflation from your mortgage rate. Okay. But let's start off, and just my first point about the historically low mortgage rates. This is the mortgage rate chart going back to the 1970s. All right. And as you can see, first of all, mortgage rates have dipped down recently. They dropped about a half point about a month or so ago. And so on the far right, you can see where they are today. And that line extends across. And you can see that, yes, they're higher now than they were a few years ago, certainly, but they are lower historically than they have been for many, many decades. Okay, so historically speaking, we are still having a low interest rate period. But let's take a look at this real inflation adjusted mortgage rate situation. Okay, in January of 2021, you could get a mortgage on a rental property for, let's just call it 4%, just for easy numbers around there. Okay, but the rate of inflation in January of 2021 was only 1.4%. So when you subtract the rate of inflation from your mortgage rate, you get your real inflation adjusted mortgage rate of 2.6%. All right. Now, this month in January of 2023, or let's say a rental property mortgage rate is around 7%. All right. Obviously, 7% is a lot higher than 4%, but the rate of inflation is 7.1%. So when you subtract that, your real inflation adjusted mortgage rate is actually negative 0.1%. And so the real mortgage rate today is lower than the real mortgage rate was 2 years ago or 3 years ago or 4 years ago. And that's very, very important to understand. All right, so let's now talk about housing supply. Okay, another thing, a lot of people are under the presumption that because the mortgage rates are rising and things like this, that there's an increase in housing supply happening. Well, the housing supply has gone up a little bit, as you can see here with this graph. But what's important to understand is that what's considered a healthy, balanced housing market is usually somewhere around 1.5 million homes on the market. And you can see back in 2016, 2017, on the very left side of the graph, there was about 1.5 million houses on the market. Today, there is about half of that, right? There's about 750,000 homes on the market. So we're literally still, even today, at about 50% of what would be considered a healthy, balanced market, okay? So there is still upward pressure on home prices. There is increasing demand for new household formation. The percentage of the population that is at that first-time home buying age is historically high right now, that particular age demographic. And there are still supply constraints on available homes, both existing resales, as we talked about, with people not wanting to sell because they have low mortgages locked in, as well as new construction, right? With interest rates high, people that are building homes are not really incentivized as much to build, especially those entry-level homes, those entry-level price points. They're more inclined to build very high-end luxury custom homes where their margins are much greater and they can borrow the money at the higher interest rates and still make quite a profit. They're much less incentivized to build those entry-level homes. And so particularly at that entry-level first-time home buyer type of home price, there is a really severe supply constraint, and that's continuing to put upward pressure on those home prices, especially in that price point. And rising mortgage rates, as we just mentioned, usually constrain supply further because people do not want to sell their homes, all right? What's going on with rents, okay? Rents are soaring and vacancy is at a historic low. Both of those things benefit the real estate investor that holds a rental property, okay? Over the last year, the Bureau of Labor Statistics says that rents increased nationally over 12% for new tenants. So when the tenant moves out of the house, they release it to a new tenant. The average bump up in rent was 12% over the last year, okay? And this housing shortage of available properties for people that can't afford them is driving more people to rent. And vacancy rates are at the lowest level they have been in 35 years. So the U.S. Census Bureau looks at vacancy rates. Let's check out this graph. There on the right-hand side, you can see where we are today with vacancy rates. And there you can see where they have been for the last 35 years. So we are at historically low vacancy rates. So there is very, very high demand, very low vacancy, and rental rates are increasing substantially. All of this benefits you if you own a rental property, all right? Now let's talk about where to buy these rental properties, because the United States is a very large area and it has a lot of very different types of real estate markets within it, okay? So when we talk about identifying investor advantaged markets, let's break down what do we mean by that, okay? So the first thing is we look for demand drivers, right? Economic indicators, demand drivers, things like job growth, population moving in, low unemployment, a diversified economy, increasing per capita personal income, low cost of living, revitalization projects happening, right? All of these things are things that we like to see in a real estate market. Now, within that, we then want to start looking at the actual real estate fundamentals, okay? So let's start at a very high level with the price to rent ratio, right? A very high level metric, also called the rent to value ratio. So if we take the purchase price and we divide it by the monthly gross scheduled rent, we get the RV rent to value ratio. So let's say some markets might have properties you can buy for $500,000 and rent them for $2,500 a month. There you have our RV ratio of 0.5%. Other markets might have a $100,000 property. And by the way, there are markets where you can buy a $100,000 property in a nice majority owner occupied suburban area, fully renovated, and buy that property for $100,000. And let's say that property rents for $1,000 a month. Well, now you have a rent to value ratio of 1%, right? Significantly more advantageous than the $500,000 property that rents for $2,500, right? So that's a very high level metric, but it's not a sufficient metric, okay? Because you also need to understand what types of expenses go along with these different real estate markets, okay? And for that, we're going to dive into a deep trick called the capitalization rate. And there we have the net operating income divided by the purchase price, right? So here we have the gross rent minus all of the expenses, taxes, insurance, property management fee. If there's a homeowner association fee or owner paid utilities, you add that in as well, landscaping, any of that kind of stuff, right? Often not the case with single family homes, but sometimes the case with duplexes, or sometimes the case with single family homes if it's in a homeowner association type of community. But then what you want to do is you always want to make sure when you're calculating a capitalization rate that you add in an estimate for vacancy and maintenance. And you can put whatever number you want in there, but you should always assume a maintenance and vacancy estimate as an expense in your capitalization rate calculation, okay? Now, that's going to give you a much more precise thing. And the reason why that's important is because a price to rent ratio can sometimes be misleading because if you don't take into account expenses. So there are some real estate investors who are sort of at the earlier part of their journey, and someone might tell them, oh, you should look for this 1% rule where the rent is 1% of the purchase price, and that will mean it's a good deal. Well, let's break that concept down a little bit and show you why it's not always the case and can be misleading. So the first property here, X, has a purchase price of $100,000 and a monthly rent of $1,000, right? So that's a 1% price to rent ratio. The property Y has a $100,000 property that rents for $900 a month. Which one looks like the better property? Well, property X looks like the better property from this view, but let's now go deeper into it and look at the expenses, okay? Property X, let's just say, is in the state of New Jersey. Property taxes are almost $2,500 a year. And all other things being equal, property Y is just simply in the state of Alabama, and those property taxes are $410 a year. Okay, so everything else being equal, percentage of everything else being equal, we go down and we see that the capitalization rate for property X, which had the better price to rent ratio, is only 6.2%, whereas for property Y, which had the seemingly less advantageous price to rent ratio, the cap rate is actually a 7.3%. So significantly higher. Property Y has the better real estate investing metrics. Okay, so that's why it's important to go that extra level and look into those expenses. And then, of course, you can keep going down, right? And you can add in your mortgage payment, and you can start to get into cash on cash returns and other types of metrics like that, right? So let's talk about now the importance of understanding property cycles, okay? Because the most investor advantaged markets change over time. All right. So we've been doing this many, many years. We've been through a lot of different real estate cycles. So I'll just give you guys a little bit of our experience historically. Okay. In 2011, our most popular market in the United States was Phoenix, Arizona. In 2012, it was Atlanta, Georgia. In 2013, it was Houston. And I could keep going. 2014, it was Dallas, and I could keep going on and extend this out. Point being that different markets were popular and advantageous in different years. And then what's typically happened with most of these markets, for example, is that home prices rose significantly faster than the rents. And that created a process of yield compression where you're paying a lot more money for the home, but you're not getting much more rent. And so therefore your capitalization rates are lower and lower and lower and lower, and it becomes less and less and less advantageous to continue to buy in those very, very expensive markets, okay? And so you want to keep moving, and we've helped our clients to diversify into different markets and to buy in the markets that are most advantageous at the time that you're ready to buy, okay? So understanding property cycles is a very important component. Here, for example, you can see the graph of the Phoenix market, and you can see the roller coaster dynamic going sort of way up, sort of way down, and going way back up. Whereas a market like Indianapolis remained very consistent. That gray line that you see there in the middle, that was the 2008, 2009 a Great Recession, right? And you can see what happened to Phoenix in the top graph, and it crashed all the way down through that recession. Whereas Indianapolis went down maybe 7% or so, but stayed reasonably flat and reasonably straight. Okay, very different type of market which is why it's important to understand property cycles and when and where in those property cycles you are going to buy, and make sure that it's an advantageous place and time to buy. Okay. So when you have identified which markets and the timing of the market, and then you have identified which type of property class to buy, now comes the importance of buying turnkey rental properties. All right. I'm going to talk about what that means. Okay. The first reason to buy a turnkey rental property is the value of your time. And I'm going to break this out into two parts here. Landlords deal with tenants and toilets and trash, whereas real estate investors make decisions and cash checks. Okay. Our clients are real estate investors. They're people that value their own time. They are not trying to spend their time rehabbing houses, managing construction crews, being a landlord, taking calls from the tenant, sending out the plumber to the house, any of that kind of stuff. But they want all of the benefits of owning the deeded freehold real estate, owning the hard assets, getting all of those tax benefits, the cash flow, the appreciation, everything else, without the headaches of being the rehabber or the landlord. So a turnkey rental property means a single family home, or sometimes a 2 to 4 unit property that's either brand new or it's already been fully renovated before you close. And it has a qualified tenant in place on a lease paying rent, so that when you close on the property, you cash flow from day one. Okay. You have inspected the property before you've closed, you've appraised the property, all that kind of stuff. So when you're ready to close, boom, you cash flow from day one. And then when the tenant needs anything or has a maintenance issue, they call the property manager. They don't call you. Property manager handles that. You get your monthly statements. You get your money into your bank account. That's how turnkey real estate investing works. And that is the type of clients that we work with. The other advantage of turnkey real estate is dramatic risk mitigation. Okay. Because you are letting someone else absorb the upfront risk of acquiring a distressed property, pricing the rehab, managing the renovation, borrowing the hard money, absorbing those upfront holding costs, absorbing the upfront vacancy before a tenant gets in there. Someone else is doing all of that. You're not incurring any of that risk. You're coming in and closing on a performing property. You evaluate the deal, you conduct your due diligence, and then you close on a cash flowing property. So you are leapfrogging over all of the normal upfront risk associated with rental properties. Okay. Number 3, you get to leverage the economies of scale of professional turnkey companies. What we do is we introduce our clients to private buying opportunities because we have relationships with turnkey companies that do this professionally at scale, right? So they are buying properties at scale. Because they do that and they can buy all these properties for cash, they get access to the best deals. Not only do they get the best deals, they then run their own construction crews because they do this at scale. And so they buy all their materials in bulk, they get discounts, all of this kind of stuff, right? And so you're able to leverage those economies of scale. It's very different from going and trying to do this as an individual, one person doing one house, okay? And finally, you get to remove geographic restrictions and buy in the best markets regardless of where you live. Because you don't have to be there to oversee the construction, because you don't have to be there to deal with the tenant and drive out to the house and do all this stuff, you have professionals that have done that, and you have property management. It's in place that's going to do that for you moving forward. You can buy in the best markets and you don't have to be restricted to your local area. Okay, so those are the advantages of buying turnkey rental properties, which usually raises the question, if I'm buying out of state, how do I conduct my due diligence on an out-of-state rental property? And this is a super important question. So let's dive into it. Okay, so the answer is you're going to do the same due diligence that you would do on a property that's right down your street, right? Unless you are a professional home inspector, which I certainly am not, and I assume most people on this call, on this webinar are not, then even if the property is right down your street, you're still going to, hire a professional home inspector to inspect your property, right? And you're going to do a whole series of other things as well, right? So whether it's down your block or whether it's in another state, the due diligence regimen should look just about the same, okay? You're going to, first of all, verify your operating expenses. You are going to make sure that the property taxes are this and the insurance is that. You're going to see the quotes, you're going to see the rates, you're going to verify the tenant is paying this rent. as well, and that they've been qualified, and this is what the lease says. You verify the expenses, you verify the rent, and then you want to verify the market rent, okay, which is different from the actual rent. And that's important because when you say, okay, this tenant has signed a lease amount of money, I know how much I'm going to get when I close, you want to make sure that what the tenant is paying is the actual market rent, meaning that if that tenant were to move out, you could have a reasonable expectation of releasing that property in 30 days or 45 days for the same amount of money, okay? And so you want to verify the market rent, verify the rent that your tenant is paying, verify your operating expenses, and then you want to also evaluate the risk of the micro markets, okay? And so you can do this. There are resources available. I'm putting a link here to one. This is an affiliate link that we have, which is actually going to give you your first report for free with a company called RentFacts. If you want to check it out, type in any address in the country, either a rental property that you own or that you're familiar with, or maybe that you're looking to buy. And what it'll do is it'll produce a report for you, and it'll give you all kinds of information about like the school district and the crime rate and all of this other kind of stuff. And it'll basically create a risk profile of a particular market, right? Based on the individual property address. It'll give you local vacancy rates and, all of this kind of stuff. And so that's very important to do as well, right? So you're assessing the macro market, you're assessing the micro market, all the way down to the address level. You're verifying all of these things. And then a tip that I usually give people is to interview multiple property management companies, right? So in these major cities, there are multiple professional management companies, right? And so what you can do is call around and say, listen, I'm considering buying this property. Here's the street address, and I'm looking for, I'm interviewing property management companies to select one to manage my property. And, I'd like to ask you some questions. And then you can ask them questions, and they will give you their independent third-party opinion, right? And maybe you're deciding between 2 or 3 properties. You say, listen, if I was to pick one of these 3 properties, which one do you think would be the property that would be most desirable to tenants, right? Which of these 3 neighborhoods do you think would rent the quickest, would be the easiest to release if the tenant moved out, right? Things of that nature. And you can get a lot of great information because these are all professional companies that manage properties full time. So they'll tell you, which ones are most appealing to tenants, that kind of stuff. How quickly do you think you could release this if it went vacant? How long would it take you to do that today if I gave it to you today? What would be the rental price you could get for it? And just verify all this stuff with totally independent companies that have nothing to do with you purchasing the property. That's a really good tip. And then, of course, you're ordering your professional home inspection, right? And you're paying for the inspection. You're hiring the inspector. They work for you, not for the seller, not for Maverick, right? They work for you. And they're going to give you an inspection report. And then all of the sellers that we work with, these companies that provide the turnkey stuff, they're expecting you to send them that inspection report. Every inspection report I've ever seen in my entire career has always had a list of things on it that they recommend that you fix. And then the seller will work with the buyer to come up with what's called a punch list. And then once those punch list items are agreed, the seller fixes them at their own expense before closing, verifies with you that they, and only then do you close on the property, right? So that's sort of the out-of-state due diligence regimen, which, to be honest, should be the same if you're buying the house right down your block on the same street that you live on. You should also be doing all of these things, for that as well. So let's talk about where did I personally buy in 2022 using my New View self-directed retirement plan money. I'm going to show you how I did that and where I bought. I bought a single-family rental property in St. Louis, Missouri, which was our most popular market of 2020. Some of our clients, I had one client that bought 10 properties in St. Louis just in 2022. Obviously a very experienced real estate investor, right? So this has been a very, very, very popular and very advantageous market. And I'm just going to give you some examples using this market of why was that the case and what do we mean when we staged, right? Specifically. So St. Louis, for example, is home to 8 Fortune 500 companies. Gross domestic product has increased 29% in the last decade. It's now over 170 billion. The cost of living is 12% below the national average. Okay. It's ranked top 10 most competitive large MSAs to do business, top 10 large American cities of the future. The unemployment rate is well below the national average in St. Louis, and it has rising per capita personal income. So all of this stuff is important, right? There's low unemployment, so you have a big pool of stable, qualified tenants with jobs. Per capita personal income is increasing, which means you can raise your rents every year. People can afford to pay higher rents because they're making more money. When you go to sell down the road, people can afford to pay more than you did for the house because they're making more money. The home price appreciation in St. Louis last year was 13%. Okay. And I will now show you the specific house that I purchased. I'm going to show you pictures of it, and I will show you the exact numbers. Okay. And by the way, I bought this property right off the Maverick Investor Group website. Exactly every single one of our clients buy their properties. So this is exactly comparable with all of the properties that our clients are buying. The price was $102,000. This is in a nice suburban majority owner occupied neighborhood of St. Louis, and it rents for $1,000 a month. Okay, it's a 3-bed, 1.5 bath house. This is what the renovated interior finishes look like on the house. All of this stuff was completed before I closed. I inspected the house. I got my inspection. I gave it to the seller. We created a punch list. They finished the punch list, and then the tenant moved in, and then I closed on this property. And I cash flowed from the day that I closed, and every month the money just comes into the account. Okay. And I bought this with my New View self-directed retirement plan. And here are what my numbers look like. All right. So $102,000. Closing costs on this one were around $3,000 or so, $105,000 out of pocket. Gross monthly rental income, $1,000. Now subtract the property taxes, $108 a month. Subtract the insurance, minus $54 a month. Property management fee, they take 10%, so that's $100. I'm estimating a vacancy rate over time of 7% and maintenance over time of 5%. Now this is brand new renovated, so new roof, new HVAC system, new hot water heater, all that stuff. So I'm not expecting any big capital items to break anytime soon or much maintenance in the first year or two. And the tenant was just placed, so I'm not expecting any vacancy the first year or things like that. But down the road, eventually, you'll have these things. And so it's good to assume them. And so my net monthly cash flow on this one for a cash purchase would be $618. Now, remember, the vacancy and maintenance are coming into my pocket, right? So that $120 is coming to me as well, right? So it's more like $740 coming in, but we're going to call it $618 because I'm estimating for the future, right? So if you include the vacancy and maintenance estimate, then the cap rate comes out to 7.2% on this property. Okay, and this is a very, very typical property. This is exactly the kind of stuff that all of our clients are buying in St. Louis this year. And if you're interested in checking that out and you're interested in taking a look at St. Louis properties that are currently available, you can go to maverickinvestorgroup.com/STL. One of the things I will mention to you, most of the pictures you'll see here, first of all, what you need to do is log in or create an account on our website if you want to actually view like the itemized financials like I just showed you and those types of property details. So make sure you log in or create an account to actually view these properties. But the other thing I'll mention to you is that there's such high demand for these properties that the pictures you're going to see are the pre-renovated pictures. Okay. And the reason for that is what you're going to do is you're going to put these properties under contract before most of them, I should say. Most of the time, you're going to put these under contract. This is what I did. I put my property under contract before the renovations were finished. And the contract said that as a condition of my closing, it's going to have all the renovations completed to this standard. Tenant will be in place, et cetera, et cetera. So I signed the contract, put the earnest money down. They take the property off the market. Then once the renovations are done, I send in my home inspector. I send in my appraiser. We do the punch out, and I get the final pictures that I just showed you, and then I close on the property. Okay, so that's what the process is. So you're going to see pre-renovated pictures when you go to the vault for the most part. There might be one or two that are done and ready to close, and if that's important to you, we can close sooner. Obviously, we can work with you on that if you're interested in something like that. But if you just want to go browse, you just want to see what types of properties are available, you can feel free to go to maverickinvestorgroup.com/STL. Make sure to log in to the website, though, if you want to peruse those. And now I want to go to the number one mistake that real estate investors are making right now in this market today. They're waiting to buy and they are losing money by not buying because they are hearing all kinds of stuff on the news about, oh, maybe there's going to be a housing crash, or mortgage rates have gone up and maybe it's not advantageous to buy anymore, or any number of other things like that. And they are waiting to buy. Okay. And I can tell you that what's people are doing is that they are losing a lot of money by staying on the sidelines, right? Because it's always an advantageous time to buy real estate if you understand where we are in the market and you buy right. What you want to do is you want to make your money when you buy, and you understand that of those 5 profit centers, at any point in the property cycle, some of them are going to be working more for you, and some of them will be slightly working less for you, but they're still working for you. And then at different points, it'll be the other profit centers that are working the most, and the previous profit centers that are working slightly less, but also still working for you. Okay. So right now we've just gone through the super turbocharged advantages of the 2023 market, which are unique and which are more advantageous than they were 4 years ago. 4 years ago, there were other advantages, right, that were different than the ones today, and so forth. So you just need to understand what the advantages are when you are ready to buy your real estate, and to get in the game and to make your money when you buy, right? So if you buy right, you buy based on real estate fundamentals, then when you close, you start cash flowing from the day you close. You start taking your tax benefits from the day you close. You start having your tenant pay down your mortgage principal and building equity from the day you close. So you don't need to speculate on what is the housing market going to do tomorrow or next year or this or that, because you're making money no matter what the housing market does, right? And so that is what sophisticated investors do, and that is how they buy real estate. And that's how a lot of people are losing money, because they're trying to do this market timing, and they're listening to a lot of different news that is saying a lot of different things. So hopefully some of this educational webinar today has enlightened you on a little bit of the market dynamics that are actually going on, and how to think about some of the stuff like inflation and mortgage rates and all of that kind of stuff, so you can filter some of that media news as it comes in. And just to close this out here, folks, and we can open it up for questions, I want to do a special offer to everybody. So I've been a NewView customer myself for quite some time. NewView has been managing my self-directed retirement plans. I have a Roth IRA with them. I also have a self-directed solo 401k with them. And NewView is super important to me. And so what I want to do is I want to make a special offer to any NewView clients or customers or folks that are on this webinar to do a completely free video consultation with, okay, so Maverick Investor Group. What we like to do is we like to get to know you, make sure that all of your personal questions are answered, make sure that we understand your buying criteria, your real estate investing goals, and then develop a customized plan to help you to meet them, okay? And so we are willing to do a totally free consultation with you at Maverick. You can just go to maverickinvestorgroup.com/newview. There you're going to be able to register for your personal consultation, and there you can bring all of your questions, and we can work with you to help craft a strategy that's going to work for you. And you can start buying rental properties in your self-directed retirement accounts exactly how I did. If you want to buy it in the same market right down the street from me, you're welcome to do that. We also have other markets that are available if those are a better fit for you, depending on your personal criteria, goals, comfort level, and everything else. And we're happy to work through all of that with you on the consult. So at this point, I want to open it up for questions and turn it back over to NewView.
All right. Awesome, Matt. That was a great presentation. I know I learned a lot about the market, and, you're right. People are hesitant right now to start buying. But I think you made some great points. They shouldn't be afraid of the inflation, and, they shouldn't be afraid of the high interest rates. The longer they wait on the sidelines, they might be losing out. I know I definitely want to schedule my consultation. So we're going to go ahead and open it up to Q&A, see if we have any questions. Okay, ask them what type of incentives
So
are.
one of the common questions that we get, which I also I want to answer up front too, is a lot of times people ask, how exactly does Maverick Investor Group make money in all of this? And that's a super important question. I want to sort of address that up front. One of the beautiful things about this business model is that you never have to pay Maverick Investor Group any money at all, which is my favorite part of this. But let me explain why that's the case, right? When I started this company, before I founded it, what I was doing is I was working in a regular office job and I started investing in real estate. I started buying rental properties and I started buying more rental properties and I was buying them in different states. Friends came to me and they said, "Hey man, how are you buying those rental properties? Can you show me what you're doing? Because I'd like to buy some too." I said, "Sure, let me show you what I'm doing." So then I started showing my friends how to buy rental properties and continued sort of doing that. And what I realized was that the real estate brokers that were helping us to buy these rental properties were getting paid commissions on all the properties that we bought, but we weren't paying them. And I was like, well, that's cool. They're getting compensated because they're doing work and they're helping us, they're providing value by helping us find these properties, but we're not the ones paying the commissions. And so I understood that in the United States, the seller pays 100% of the real estate commissions. The buyer pays nothing, right? And so I was like, wow, when I started my business, I was like, so if I could just get a real estate brokerage license, I could keep helping my friends buy real estate and not have to charge them any money, but I could get paid, right? And then I could have a viable business. I was like, this is perfect. And so that's how Maverick Investor Group started. And so we are a licensed real estate brokerage, and every property that you close on, we are going to get paid a referral fee, but it's going to the seller instead of from you, right? So these turnkey companies, instead of paying for sales and marketing, all this kind of stuff, we can just bring them clients. And then at closing, they pay a referral fee to Maverick Investor Group, our brokerage. And that enables you, the buyer, to work for us with us totally for free. Video consultations, personalized support, free educational stuff, all of that. You never pay for any of it. And in fact, we only get paid if we can deliver enough value and help you find the perfect property that's that meets your criteria, such that you decide to close on it, passes all your due diligence and everything else. Because if we can't do that, then we make no money at all, right? And so it puts the incentive on us to deliver value upfront to you. And so we want a business incentive for our company. That's how it works. So we work with you and you don't ever have to pay us any money, but that is how we get paid, just so you understand the whole sort of financial business model.
Interesting. Okay, so we do have a question that came in. Will the tax incentives you mentioned earlier in the presentation, will it help to offset the high interest rates?
So will the tax incentives for providing housing help offset the high interest rates? Yeah. And depending on how you buy these properties, you may have already a tax shelter inside your self-directed retirement plan, right? So that's something you consider. You do get into some nuances, though, if you start using leverage inside your retirement plan and stuff like that, which might create a certain type of taxation, which can be offset through some depreciation. I don't want to get into too much of the tax advice because you definitely want to work with a CPA on how to do this. But the other thing to remember about interest rates, okay, so the first thing is you're going to get understand what your mortgage payment is going to be. And you're going to stick that into your cash flow analysis. And you're going to say, okay, I want to make sure that I'm going to have a positive cash flow, meaning after I pay my property tax and insurance and management fee and my mortgage at this interest rate, I am still going to have a positive cash flow, right? So you want to be able to assess and make sure that that's the case, first of all. And then assuming that that's the case, you have to remember that you are in a very advantageous position as the borrower, because when interest rates start to go down, right, which a lot of people think they're going to eventually start going down before too long, you are able to refinance your property and lock in a lower interest rate, okay? And you can continue to refinance as interest rates go lower and lower and lower, refinance, and you lock into lower rates until you're at the very bottom of the next cycle. And then when they start to go up, you just keep your low mortgage, right? And you're one of those buyers that's hanging on to their low mortgage, right? So You want to be able to buy now and have it make sense now and positively cash flow now. And also, you have the advantage of being able to refinance and continue to lower your mortgage obligation once you see rates start to drop.
All right, awesome. Thank you again, Matt, for joining us. I don't see any other questions coming in. We'll definitely be bringing Matt back for our panel with the rest of the speakers. And then there's, just so you know, I'm going to recap who's coming up next. We have Whitney Elkins Hutton. She'll be talking about investing in car washes for appreciation. And that's next Wednesday. Following that will be Alex Quesada talking about self-storage. And then our Mark Osipek will be talking about investing in distressed real estate. And the last speaker will be Don Pitts talking about why trust deeds belong in your self-directed IRA. Thank you, everyone, for joining us again. Remember to submit your panel questions so that we can answer those to all of our guests at the end of the series. Have a wonderful rest of your day, and